We have somebody joined. Hi, Smita.
Hello.
Welcome.
Thank you very much.
Okay. Hello, everyone. Welcome to our second part in the educational series, which is relationship status. My name is Aisha, and I'm the founder of Public Allies. Public Allies is a nonprofit established to promote healthy and vibrant living, community living together in harmony. Our primary objective is to help and support the most vulnerable members of the society by overcoming their challenges. So today we have our experts, three experts with us. Let me start introducing them to you. Our first expert today is Andrea Vladescu. She's an accountant. And Andrea, please, can you tell us more about yourself?
Thank you, Aisha. Hello, everyone. My name is Andrea Vladescu. I'm an accountant. I help small businesses and individuals to manage their financial health and growth by offering accounting services and tax planning and preparation services. Before I start my professional practice, I worked for more than 20 years as an accountant, doing financial reporting, cash flow management, internal controls to both profit and not-for-profit organization, and assisting with accounting software implementation as well. Thank you very much, and I will pass it now to...
Thank you. Yeah, thank you so
Aisha.
much, Andrea. Okay, our second expert today is Neeru Padmanabhan. She's a financial services expert. And Neeru, please tell us a little bit more about yourself.
Hi, everybody. Thank you so much for joining us today. And thank you again for Aisha for hosting this wonderful educational series. I've been a financial professional for about 1.5 years. Prior to that, I was a social services worker. So I worked in shelters, nonprofit programming. I was a case manager, worked various different fields. And one thing I kept on running into was regular people ending up in shelters. On my caseload, I would have seniors. Sometimes more than half my caseload was seniors, and this is just regular people. I would have people with chronic illnesses, cancers, disabilities. I would have families that are ending up homeless due to cash flow issues. I would have widows and widowers ending up on my caseload. And sometimes when I just saw regular people ending up, and I said, this is not the way things are supposed to be. I learned things differently in school, and this is not supposed to happen. And then as I realized, as I got more into it, it was really had to do with financial literacy and access to financial products. And I realized as a system, we don't really do that. As an educational system, we don't do that. As a financial industry, we kind of lay back on that. So what I did, instead of saying they should do something about it, I finally said, I'm going to do something about it. So I left my cushy career, all my titles, and about 1.5 years ago, I took on a new title as a financial professional. I got licensed, I got trained, and here I am today. And I absolutely love it. And thank you so much for allowing us to present on this. So back to you, Aisha.
Thank you so much, Neeru. And last but not the least, we have with us Jina Sang, who is a lawyer, and she practices family law, Wilson Estate. So Jina, tell us a little bit more about yourself.
Hi, everybody. And again, much thanks to Aisha and to Public Allies for agreeing to host our webinar series. So as Aisha mentioned, I am a lawyer. I practice family law in Wilson Estates. I've been in practice for 11 years, and I started out in a small firm, had some corporate experience for a couple of years, and then decided to start my own firm. And I've been finding that very rewarding, terrifying at the same time. But part of why I'm doing this was because I met Neeru by chance, and through Neeru, I met Andrea, and the three of us got to talking. And, you know, throughout our experiences with our clients, we realized that a lot of people get information sort of in silos. So very much so, okay, well, you know, if you talk to a financial advisor, you get financial literacy information. You talk to an accountant, you get some information on tax. You talk to a lawyer, you get some legal information, but not necessarily how all three areas sort of intersect and impact each other. And more often than not, I always encourage my clients to bring into our conversation any professionals that are in their lives that potentially impact what they're doing. And so through my discussions with Niru and through my discussions with Andrea, we thought that we would put something together to at least have some basic information out there, and also for people to realize the value of getting professional advice, and not it doesn't necessarily have to cost a lot. A lot of us offer free initial consultations as well, and but knowledge is power, and that's what we are here to do. We're here to empower people and to have some basic information to know where they should go in terms of finding out their next steps in terms of what they're dealing with.
Thank you so much, Jaina. And I agree with you, knowledge is power. And so please go ahead and teach us more about relationship status and how it can help everybody.
All right. So again, like I just mentioned, we are offering the webinar to provide general information, and we're not here to provide any type of legal or professional opinions on your specific situation. So if you do have something that you are dealing with, we do highly encourage you to speak with a professional about your particular situation. And as mentioned, this is part 2 of a 4-part education series. So today we are focusing on talking about different considerations for people in relationships, and specifically things that impact tax filing, financial planning, and legal rights. So first off, we'll start off in terms of our series with the first topic, which is focusing in on common law spouses. And now with common law spouses, depending on how you're looking at the common law spouse and what situations you're dealing with, there are 2 actually very different definitions. So on my end, from a family law perspective, 2 people are common law spouses if they have cohabitated or lived together as a couple for at least 3 years, or if they were in a relationship of some permanence for any length of time, and they have a child together. But there's very different definitions from a tax perspective, and I'll let Andrea take over from here.
Thank you, Jaina. So from tax purposes, in order to qualify as common law partner, a Canadian taxpayer has to be cohabiting in a conjugal relationship with another person throughout the last 12 months. When the couple in a conjugal relationship has a child together, automatically qualify as common law partners, regardless of how long they have cohabited. So that 12 months period is waived, and they are qualified right away as common law partners. And there are some tax benefits to be considered as common law from tax purposes. And I would like to mention, if you have a child, the childcare expenses can be claimed by the common law partner with a lower net income. If lately the GST, HST credit got some changes, and the common law partner are the ones that are affected by this change. So if you are a common law couple with no children, you will not longer be eligible for the maximum GST HST credit once your combined income is more than 38,000, and you will not get any credit once the income exceeds 50,000. So it's good to have this number in mind. Many people who qualify for GST HST credit on their own will no longer meet the requirements once they file a common law, given that the government will combine your net income. So the 2 common law partners' incomes will be combined, and then this makes you not eligible to claim the HST, GST credit. Another benefit that the common law partners has is it's called the common law partner amount, and you can support. So one common law partner can support the other one with the condition that the net income is less than 12,298. This is the amount for 2020. This amount change every year. So it's better to be updated on the Canada Revenue Agency website. You will find all this information updated every time at the beginning of the year. Let's talk about pension income splitting. In here, we can consider RRSP. RRSP allows you to split your retirement income with your common law partner by allowing the person with the larger income to make contribution to their spouse, partner's RRSP. And this is a good tax reduction strategy on the long run. Medical expenses can be claimed by either spouse. So adding all the claims on the lower income spouse return could result in a larger benefit. I talked a little bit before about RRSP deduction. I would like to mention also RRSP deduction will reduce not only the tax payable, but net income, which in turn may increase your Canada Child benefits if you have a child. So it's good to contribute to RRSP from that point of view. In the case of Canada Child benefit, your maximum available benefits, including disability benefits, will be reduced when family net income exceeds 30,000. So these are some point of reference when you would like to, when you have to fill in your income tax return at the end of the year. And another point that I would like to mention here is that unused tuition fee and disability credits may be transferred to a supporting common law partner. Just to mention, all these benefits, tax benefits are available, but not everybody can benefit from them. So it depends of everybody's situation. And that's why you need to check CRA website, to check with a professional to see what fits your situation and how can you decrease your tax payable at the end of the year. In the next slide, I will leave it to Neru to explain the financial impact for common law partners.
Hi, everybody. So I'm going to try to keep it super simple because in married partners, I'm going to go over a little bit more thoroughly about plans. But all the information that I'm going to talk about in common law partners and married partners and individuals, they're going to have some of the same facets in it. The plans are going to always look very, very similar, and they're going to look pretty much the same, except with a few individual things that are added to each plan and catered to individuals. But a lot of times when I sit down with individuals, businesses, families, and different types of partners, I often find that a lot of individuals don't realize it's based on your goals and dreams. So if we're making a financial plan, I'm going to ask you, hey, do you want to buy a home? Do you want to travel a little bit more? Do you want to pay down some debt? What are those financial goals and what do they look like for your family? What are you putting aside for each pot? So for example, my best thing is travel. When I talk to individuals about travel and they say, oh, I love traveling, I love going here, I love going there. And I said, okay, what does that look like? Is that one big trip a year or little multiple trips spread out? So whatever those trips look like, are you putting a pot of money aside for that? Because if you are, it changes how how you're actually going to vacation. Are you going to be able to have a vacation where you get to buy everything that you want, get to do everything you want? Or is it going to be a harder vacation on you where it's going on your credit card and you have to really pinch your pennies? So that's why goals are so important. So whenever I sit down with a family, I ask them what their goals are. And this is how a key financial plan starts. It's based on your goals, your dreams, and what you want out of your future. And understanding where you're at right now. So where I'm now, where am I? So what does my current financial situation look like? Whether that's, lots and lots of money that I have, or, if I have a meager income or if I have a smaller income. And where do I finish? What's my end goal? So once I can know where I'm at and where I want to finish, then I can start by analyzing my cash flow. So I know what's coming in and I know what's coming into my income. So every family that I sit down with, wherever they're at, I start by analyzing their cash flow. I definitely don't question their living expenses. We can take a few looks into that, but I look at how much tax they're paying. I look at how much um, they have in debt, and we look at reducing those pieces and creating more cash flow. So once we can reduce debt and once we can reduce taxes, just like Andrea talked about, we can create a whole bunch of pocket of savings, which you just didn't even know that you could have had. And whoop. Okay, sorry, technical difficulties. So value of advice. As Jana pointed out, there is a premium to getting advice sometimes, but it doesn't have to cost you. So on average, households that work with financial professionals, that work with any type of professionals, tend to perform 5 times better. So in this case, I have a financial graph by Ipsos, and it just lets you know that families that work with similar income groups and similar ages, if they tend to work with a financial advisor, they do tend to have higher incomes, because when you're working with a financial professional, you're working with a legal professional, accounting professional, they're going to know about all the changes in programs. They're going to know about milestone products that have just come out. They're going to understand how investing works, and they're going to let you in on it, because as Jana said, knowledge is power. So when I look at different plans, I just want to quickly touch on it. When individuals cohabit, when they're common law with children, when they're common law without children, their plans are going to look slightly varied, just a little bit different, and a little bit they're going to look a little bit different than regular plans. So I have clients that are cohabiting and they're in a common law relationship. They've lived together for 5, 6, 7 years, but they still have separate counts. They don't have a lot of joint. I'll try to get back into it. I'm so sorry. When we're looking at individuals that are cohabiting, we often have people who have been cohabiting for years, but they don't really have any significant financial assets together. They don't have a financial plan together. And when I sit down with families like that, individuals like that are cohabiting, I let them know that you still have to develop a separate plan, even if you're considered common law, but you're not sharing any significant assets. That's where you have to have your own plan in place. So what does that look like? Having your own will, looking at analyzing your own cash flow, looking at your own debt manage, looking at an emergency fund for yourself, and proper protection for yourself. So in case something ever happens, you're able to take care of your income, you're able to take care of your own life if something ever happens, and you're able to invest your money. So looking at that cash flow and that wealth preservation. And when you're looking at investing and that cash preservation, you're also managing your pension funds, like your RSPs, your private pensions from your work, and you have an emergency fund, or you have invested funds that are liquidatable. So in case anything ever goes wrong, or even if in case things go right and you need a little bit of lump sum of money, that you're able to get access to it. So I'm finding a lot of people now are putting their money into safer places like GICs, but they're not aware that sometimes when you put your money there, that it's locked in, so you can't get access to it. So just reminding people when they're cohabitating together and they're common law partners, and they don't have any financial assets together, you still have to have your own separate plans in place, because there's nothing tying you together on plans, and especially having your beneficiaries in place, having your wills in place, because somebody needs to be there to take care of those final things. And somebody needs to be there to take care in case something goes wrong, if you get sick or hurt. So having that key financial plan for yourself is so, so important. And common law partners with no children and common law partners with children, they're going to look very similar to people that are married. Those plans are going to look very, very similar. So I'll touch on key plans when I get to married. But for right now, what are your future plans? Your will planning, your insurance beneficiary, your successor owners, critical illness, your disabilities. When you have no children, you definitely want to make sure that you have facets of a plan there, but you want to look at having your will in place. If you having your insurance, having each other as beneficiaries, and not only writing yourself as beneficiaries, but something called successor owners of each other's policy. And looking at critical illness and disabilities. These are insurances that cover your ability to earn, looking at debt and savings balance, and knowing where your debt is, how to pay it down together while you're cohabiting and you're working towards your goals together. So having couples goals on everything that you're doing. And again, having that emergency fund. So many people didn't have that emergency fund. And when you're investing, just like Andrea talked about, spousal RSPs, transferring those pensions over. And if you have private pension plans and you left a job or you're currently working at a job, looking at where that pension plan is and how it's performing, and looking at government grants. So we all know about registered education savings plans, but when individuals have disabilities, and this will apply for cohabiting individuals as well, is that's a plan that pays you if you have a disability. It's a government grant. So how to access that, how to get it growing for you because it's an investment account, how to get that moving. And individuals with children will have same things as common law partners, same things as cohabiting partners, except this time you're going to have to take into place that you have children. You want to make sure that when you're will planning, your estate planning, that your children are included, that your children's children are included if you want them to be. And your insurance and beneficiaries, your contingent beneficiaries are set differently. You have somebody to take care of your children in case something happens. You're naming people on those wills. And as each other's spouses, your successor owners, and your children have somebody there that will take care of them in case both parents pass. And making sure that debt and savings ratio is always balanced. So you're not only paying off debt, but you're paying off savings, and you have that emergency fund, and you're investing long-term and short-term. And that'll be the same thing. It'll be spousal RSPs. And this time you're going to have access to registered education savings plans. For lower income families, you have access to Canada Learning Bonds. And registered disability savings plans, you'll have access to it. If there's a disability in the family, you'll also get access to credits alongside of that. So tax credits are also part of that. And also managing those private pensions. So different plans for different stages in your life and different parts of your life. So as you move along from cohabiting to taking that plunge into common law, to having common law with children, those plans are all going to have similar facets to it. And just the facets of a sound plan. So what does that look like? Life and income protection. So whether you're rich, poor, middle class, somewhere in between all of those, your plan is always going to include life and income protection. So that's sound plans. Debt and savings ratio with pieces of an emergency plan that's accessible to you if something happens. This is about 3 to 6 months of your income saved up in an account, put into a TFSA or some kind of savings where you can have access to it in case something like COVID happens. and you have your diversified investments, and you then understand what vehicles, what investment vehicles work for you in that diversification. What are the best tax implications? What are you wanting to save for today, saving for tomorrow? And what are those vehicles for you? And now I'll pass it over to Jaina.
Thanks very much, Niru. So going into some of the not so happy topics. So if someone in a common law relationship is thinking about separation or is going through separation, here are some things to think about. Niru, so next slide, please. Okay, so for spouses that are in common law relationships versus spouses that are in married relationships, they do enjoy a lot of the same entitlements with respect to child-related issues and also with spousal support. Where there is a big difference in the family law realm is the property division entitlement. So in common law spouses, so spouses that are not married to each other, but they have lived together for more than 3 years, or they have a child together and is in a relationship of some permanence, there is no automatic property division. So where the couple have joint property, so if they own a home together, then that property will be divided equally. And, you know, if they have shared bank accounts, shared investments, and, you know, any other shared properties and things like that, those would also be divided equally. And outside of that, for married spouses, which I will get into because that's our next big topic, the only way that a common law spouse can get something from the other spouse that's not held jointly is potentially through unjust enrichment claims. So, you know, for example, one of the potential claims could be that if the house that the couple live in is only owned by one person, but the person who doesn't own it, let's say, has put down $6,000 towards a roof repair. Now that they are breaking up, the spouse that does not own the home is leaving the home, and so they potentially have a claim against the homeowner spouse to try to get some of the money that they have put into the house back, because they don't automatically get that back. And so that is something that would have to be negotiated or requested for at court. With respect to debts, each common law spouse are responsible for their own debts, and in terms of joint debts, those are both people are on the hook, and then it's sort of, if people are not making payments, then it's up to the financial institutions to go after both. And you know, as some of you may know, banks tend to go after the person, you know, that is easier to get money from. So, you know, where there are bank accounts that the bank already has. And so the bank doesn't necessarily and would not necessarily be required to only go after 50% of the debt from each person. So that's something to think about as you know, engage in any joint debts with your common law spouse. With spousal support, there is definitely a possible spousal support entitlement. Again, the same with married spouses. It does depend on the circumstances. It's not an automatic entitlement. It depends on what roles were taken by the parties during the relationship and any other issues that would contribute to a claim for spousal support. So next slide, Niru. Okay, so for common law spouses, here are some ways that you can protect yourself. So as a proactive measure, when you start to live with somebody, one of the things that you should be thinking about is to have a cohabitation agreement in place. So this agreement, you can specify how joint living expenses are to be shared, like, you know, whether it's 50-50 or if it's 60-40 or whatever the percentages are. It can also clarify any property ownership. So, you know, if one person is bringing a property into the relationship, so the agreement can specify that the other person absolutely has no entitlements whatsoever to that property, and that the property, if that was sold to fund a purchase of another property later on, that there's traceability there. And if you want more information, I'm happy to chat with you about that on a one-to-one basis. Cohabitation agreements are also great to either confirm that there is some sort of spousal support entitlement, or that both spouses confirm that they're waiving that spousal support entitlement, such that no one will be allowed to claim spousal support from the other person in the event of a breakdown of the relationship. And finally, it's great to clarify any estate rights. So if someone passes away, what are the expectations there in terms of inheritance and entitlements and things like that. As a reactive step, so if someone is thinking about separation or is beginning the process of separation, one of the things that they should think about is putting a separation agreement in place. And the hope there is that the spouses are amicable enough that they are able to come to an agreement on all of the issues that they're dealing with, and that it can be finalized by way of a separation agreement instead of being forced to go to court to deal with the issues, because then that is much more costly and takes much more time as well. So the separation agreement you can see there can include terms to close out on all or some of the issues depending on what the spouses are able to agree on. And last but not least, Neera's already touched on that, but will updates are very important because you want to make sure that, if you previously, in a previous will, you had your common law spouse as a beneficiary, that now that you are separating and you don't want that person to be a beneficiary anymore, that you update your will to remove that person from being entitled to something from your estate. And also, updating your will is also important if there are children or spousal support considerations, that those are made and covered in your updated will. Okay, so Neera, next slide. Okay, so we're now moving on to the second main topic of our discussion, which is the considerations around married spouses. And I will let Andrea take it from here.
So for married spouses, there are almost the same tax benefits as for the common law partners. And I will just talk briefly about them, not to overwhelm you again with the information. There is a basic personal amount that can be claimed, which is a non-refundable tax credit that every Canadian is entitled to claim on their tax return. And as I mentioned, with the common law partners, the amount is $12,298 for 2020. There is the disability amount that can be transferred to the spouse, given that their situation allow this. Pension income amount that can be split. Contribution you make to your spouse RRSP can be deducted from your taxable income. I just want to advise you that the contribution you make to a spouse RRSP will reduce your own deduction limit, so be careful about that. Also, another component is the age amount for people over 65 and over. Medical expenses that can be combined, and you can apply the deduction to the tax return of the spouse who can use it more effectively. So that will give you more a lower tax return. Sorry, lower tax payment, not tax return, a higher benefit. There are also charitable donations that I didn't mention before for common law partners. Also, once you combine the charitable deduction, you will get credit of 15% for the first 200 in donation. And then that will increase to 29% for over 200. Canada employment amount, it's a credit that is available for Canadian taxpayer with employment income, excluding those who are self-employed. So those are not eligible for this credit. This credit is available to help offset the cost for work-related expenses such as uniforms, home computers, supplies. So it's good to keep in mind that you can benefit from this. In the next slide, I will like to make you aware that each Canadian, by the Income Tax Act, by the rules, needs to file their own tax return and indicate their marital status on the return, who they are married to or living with in the case of common law partners. Failing to indicate the correct marital status is considered fraud, because CRA based the calculation so much on this information on marital status. They calculate the benefits, deduction and tax credit based on your household income. So that's why it's so important. If you receive benefits and you are not entitled to because of your incorrect marital status, you will be asked to repay the benefits back, but with a penalty and interest, which is considerably high all the time. So just be aware of this. And in the next slide, Neri will take over to explain the financial planning part.
Thank you again, Andrea. I think I flipped that slide a little bit more quickly than I thought. Sorry, guys, I got a little bit thrown off earlier when we got Zoom bombed. So my information wasn't as flowing as I had anticipated before. So my apologies. So it might be a little bit repetitive, but I will do my best to streamline what I'm going to be saying. So when we talked earlier about different types of families, whether they're cohabiting, whether they have children or not, when they're married, also when they're separating, there's going to be a lot of repetitive facets with financial aspects to your plan. The main thing to remember with your financial plan, it's a living, breathing piece of your life, and it's constantly going to be changing as your life changes. But the pieces that it's definitely going to include is your cash and debt flow, your tax planning, your investment planning, your retirement planning, estate and wealth transfers, and what your risk management is on all of those topics. So your financial plan is going to be based on your goals, and you're going to start by analyzing your cash flow and understanding what your end goal is. What are you doing this all for? So when we look at married spouses and their financial planning, we want to make sure that they're looking at their strategy number one, making sure that their life is protected. And what is life protection for? It's to pay off any debt, replace any income, so you can have a peace of mind. If you want, you can pass on a legacy to your family. And this money is completely tax-free, and it passes this probate process. I don't think Jana mentioned it in this one, but probate is the provincial taxation process. And everybody goes through that process. But if you have a will in Canada, if you have your assets and your estate set up in a certain way, you'll have less implications of this. So life protection is so, so important. And there's more than one type of option when it comes to life protection. So looking at that strategy number one is basically having your life protected to take care of the people that you're leaving behind or creating a legacy within your wealth. And then the second piece of that is income protection, is protecting your ability to earn and garner income. So this is disability income, disability plan, where you have a monthly income flowing in. This is 70% of your benefits that come to you monthly if you're unable to do your job. Then looking at something called critical illness insurance. We all know people that have been touched by a heart attack, stroke, cancers, bypass, and what happens to them at that time? Are they able to work? Are they able to take care of themselves? Do they need an extra cash flow to hire somebody to take care of them? Where does that money come from? So if you're unable to work and you're unable to bring in income, it derails your plan. That's where you're taking out of your RSPs, you're taking out of the equity of your home, you're taking out of pools of money that you've saved for your long-term savings. So making sure you have disability income, a monthly amount flowing in case you get sick or hurt, or making sure you have a critical illness piece in case you get major illnesses, major diseases, and it'll pay out a one-time lump sum tax-free payment for disability and critical illness. So these are all tax-free amounts. And individuals, I constantly say this, I know we're going to be doing a business webinar as well, but business overhead insurance for individuals that have high overhead costs, that have a brick and mortar shop. If you don't go into work, who's going to pay the bills on that brick and mortar shop? It's going to come out of your personal income, out of your family's income, whether you're a common law, whether you're cohabiting, whether you're married, those costs are still going to happen because life still happens no matter what happens. And I always tell individuals, if they're self-employed, you don't qualify for EI unless you specifically pay into it. So employment insurance is for those who are employee-based or paying into that plan. In that case, you need to make sure you have disability income on your own, and you can get your own personal extended health insurance at that time as well. These are key pieces, especially for families as you build a family, so you don't derail yourself. I like to say 98% of the time, something's not going to happen and life is going to go amazingly by. But for that 2% of the time, you want to make sure that your life and your income is protected. And then you have a balance of your debt, savings, and emergency fund. So when I talk about debt, I'm going to expand a little bit on here because lately I've been getting a lot of questions around debt, and there's a lot of changes in our financial landscape because of COVID. Interest rates have never been lower than they are today. There's never been more opportunity to get mortgage rates as low as they are right now. This is a good opportunity to look into consolidating debt if you're able to do it, if there's extra equity in the home. Not everybody's going to qualify, but if you do qualify, if you have credit cards, a lot of people don't understand when you're paying off debt, interest rate is really, really important. And I'm not saying that, debt is going to go away and debt is the first thing that you need to deal with. It's just a piece of the pie. It's just a piece of that balancing act that you need to get a hold of and get a control of your debts so you can learn to manage it and learn to eliminate it. So just maybe even asking the bank, hey, I have a really high interest rate on this credit line. I have a really high interest rate on my credit card. Are you able to decrease the interest rate on it? Lower interest rate credit cards are out there. Sit down with a financial professional because there is a fine way to pay down debt while you're saving short-term, long-term, saving for retirement. So savings is so key. And I don't know if you've heard of the old adage, pay yourself first. This is a real thing. Before you do anything else, pay yourself first. And it doesn't have to look like $1 million. There's lots of myths around wealth saying you have to have money to build money. You have to have wealth to build wealth. That's not the truth. All you need to have is habit and consistency. So if you put away $25 aside every month for 30 years, I'm going to let you know that's going to compound and amount to something good for your future. And if you have it put in different pools, diversified in different investments, that's going to grow for you. And having an emergency fund. So this is so key. And I constantly remind families about this, whether they're married, cohabiting, and or on their own, if they're business owners. 3 to 6 months of your income saved up, whether it be in some type of account, some type of investment, but just to know that if you need it, it's there. It's liquidatable. You can have access to it without unlocking it out of account, without having huge tax implications, without having to do a whole bunch of paperwork, because good things and bad things happen, and there's good emergencies and there's bad emergencies. I constantly tell people, so having 3 to 6 months of your income saved, set aside, sets you up for time to think your thoughts out, to have the opportunity to game plan for the next step. So I sat down with a lot of clients that that struggled with this a lot. When COVID happened, they didn't have 1 month of income set aside, and they had to really wait for that CERB, and they couldn't wait till that CERB came in. But that made them get one month behind on their bills. A special mention out on OSAP. So I am sitting down with a lot of clients that have OSAP debt. So that's the Ontario student plan. So if you get a student loan, that's where you would get it from, is OSAP. And I have individuals that I'm sitting down with nearly $50,000-$60,000 of debt on OSAP. And what they've done is they've consolidated that debt into loans in different processes. And OSAP, those debts are lower interest. They're about 5%, 4.9%, depending on which province you're in. And they have a lot of flexibility to them. So I'm finding that families, individuals that are cohabiting, especially that beginner stage, what they're doing with that debt is they're trying to consolidate it and they're trying to snowball it down, as we would call it in financial terms. But what they're doing is they're not saving. And sometimes when they're trying to consolidate that debt into so many other things, they forget that OSAP and student loans have flexibility. So understanding that each debt has its different pieces to it and it can be paid down on its own. So sit down with a financial professional and figure out what all those pieces are. Don't make it super hard for yourself. Let us do the work for you. And just diversifying the vehicles. So here, I'm not going to get into a big fat explanation about what each pool is, but all this is to show you is that we have different options in Canada. We're known for our financial acumen here. We're known for our financial system in Canada, and we have multiple different pools where you can invest and put your money. And the only difference is how they're taxed. And Andrea covered, there's lots of tax benefits out there. And we have more than one type of product that you have access to, that we have access to as Canadians. And we're really lucky that way that we can get access to all these things. So just remember, what are the key things there? The key things are having your insurance in place, making sure that your life is protected, your income, your ability to earn is protected, making sure your debt savings is balanced with an emergency fund, and making sure you're diversifying your investments and your savings plan. So whether you're saving for today, tomorrow, or the future, you have lots of options out there. So this is what is going to happen for common law partners, married partners, individuals, families, blended families. There's so many different ways we can look at family and define family. Whatever that looks like to you, there's a plan out there based on your income. All the sound facets of a plan, only thing that differs them is your goals, your dreams, and your budget. So whatever your budget is, there's a plan out there and there's a sound plan out there. So let somebody do the work for you and figure out what that plan is. So off to you with investment and tax implications.
Thank you, Neru. Your explanation says everything, says it all. So I will just want to add more things to it. It depends of which investment vehicle are you going to use. The tax implications are different. So, for example, when you invest in a GIC, which stands for Guaranteed Investment Certificates, or a savings deposit, or bonds, you receive interest income. This interest income is taxed at the highest marginal rate. Keep that in mind. When you invest in stocks issued by, let's say, CCPC, Canadian Controlled Private Corporation, they issue dividends, they pay you dividends, and you can get a dividend tax credit, which will lower your tax payable. When you invest, other type of investments that will generate capital gain, for example, real estate. When you sell your investment for a higher price than what you paid for, then you will get that capital gain, and the CRA tax you 50% of the capital gain which is good. So they don't tax 100% of the gain, is just 50%. Just to give you an information about the capital gain lifetime exemption for an individual is 883,000 as 2020. This amount will change every year. It's indexed by CRA, but this is available for you to lower your tax payable. Another type of investment could be life insurance, right? Which is very, very good, you know, to protect your assets as well. And you can have life insurance as a person or as a corporation. Most amounts received from a life insurance policy following someone's death are tax-free. So it's good. And also when you invest as a corporation, you have many benefits of doing that. I'm going to touch more on that when we in our third webinar, which will be September 29. And when we are going to touch everything about all type business structure in Canada. So at that time, stay tuned, and you'll find more about life insurance policy for corporation, under corporation, and the tax implication. Just want to mention briefly that as long as your investments are held in a tax shelter plan, tax shelter plan means RRSP, RESP, TFSA, then the income is growing tax-free. When you cash those plans, then you will be taxed in case of RRSP and RESP. But there are lots of strategy that you can use to plan for in order to pay lower tax. I think we are good to go for the next slide now.
So I'm just going to recap some tips. Again, I've gone over it a few times. I'm so sorry, I got a little bit thrown off when we got bombed, but I just want to mention that there's specialized investments based on your situation, and building wealth, again, is on consistency and habit. Investing is a long-term strategy. So a lot of people think that it's based on putting it in today and taking it out 10 days later and you're going to be a millionaire. Yes, there are certain situations where you have access to certain strategies that might build that, but investing is definitely a long-term strategy that's based on consistency and habit. And statistics will show, financial projections will show that there are always drops and falls in the market and ways that you invest, but it's about staying into it and looking at the quality of your projects and constantly evaluating them. So setting up a budget for your plan and what you want out of your goals and your future will be based on knowing what's out there, knowing what's how to educate yourself. So if you have a plan and you can set aside $100 for it, that's great. So where do we want to put that $100 to maximize your plan? So sitting down with somebody like Andrea, who knows all the tax implications and benefits out there, sitting down with somebody like myself, who knows that. And when your family's splitting apart, when your family's dividing its assets, sitting down with somebody like Jaina, who knows how to split those up appropriately with less implications as possible. So we're going to be having our last webinar series. It's going to be on estate planning and preparedness. So the estate planning process, probate process, is something everybody in Canada is going to go through, because it's the process that you go through when you pass away, and we're all going to pass one day. It's just a reality of life. So that webinar, I highly encourage people to register for, to come for, to watch on Facebook Live. We're going to have a follow along sheet that's going to show you where you kind of need to have everything, and you kind of want to have anything. And we're going to have more examples in that one. But it's going to be so important when you plan out where your money is and where it's at. how it's going to pass over to the next generation and how it's going to build a legacy within your family is so, so important. And I'm constantly telling people is to manage their private pension. So when I got into finance, I'll tell my own story. I found out that I had a $40,000 pension sitting somewhere from an old job that I worked at for 8, 9 years. It's crazy what you can find out with that knowledge. So if you worked at an old company and you did something called a work match, sit down and find out about those. Call those companies and see if they still have the work match program, if they have your old investment. These are Manulife, Sun Life, Great West Life, IA Financials. Different companies do work match programs with your company or your previous companies. Did you contribute to that? So I know so many people don't keep a track of that. I definitely didn't. It's only when I got into finances that I learned about it. So having those private pension plans and converting them into your own plan so you can keep a track of them. There's actually hundreds and hundreds and thousands of dollars out there in old lost plans, in old lost accounts that are out there that were never accessed. So these take paperwork to access. You have to tell the company that you want to access the money, otherwise it sits there. So I tell people to transfer this money into their own accounts with their own persons, and looking at that will be called something called a locked-in retirement account. So it'll be called the LIRA. And most private pension plans from companies, according to statistics, are underfunded by 50%. So maximizing that investment. So recently I helped one of my clients find $10,000 in a pension plan that she didn't even know that she had. So that was amazing. That's going to go towards her wealth. Looking at RESPs, RDSPs, government grants, and especially for lower income families. They don't know about Canada Learning Bonds. So most families won't even register for a Canada Learning Bond when they're lower income. It's free grant money from the government. So learn how to set that up. So if you know a lower income family, have they register for a Canada Learning Bond for their children? And if they have somebody has disability in the family, RDSPs are amazing, registered disability savings plans. And we've said it a few times already. Andrea's talked about it. Spousal RSPs, Jana's talked about it, so I won't talk about it too much. And just looking at those health and disability plans, especially for entrepreneur families. There's so many tips out there. There's so many things that we can do as Canadians to maximize our plans, because we have so many products out there and so many services out there. It's absolutely amazing. So again, as Canadians, we're very, very lucky, and we're known for our financial system, but it's how we're accessing it and the knowledge that we have to access it that's kind of lacking. So let's fill those gaps in and get access to the best products, the best services, and maximize those plans so we don't have people ending up and accessing shelter systems when something goes wrong. So thank you so much, and I will hand it over.
Thank you again, Neru. So we talk about common law partners, we talk about married couples, and now it's time to talk about separation and divorce. From a CRA point of view, living apart for less than 90 days is not considered separation. Even the legal perspective is different. It's better to consider both sides when you take a decision, and when you the decision of separation, and when you file your taxes at the end of the year. Once you have been living apart for 90 days, the effective day of your separated status for tax purpose is the day you started living separate and apart. In that moment, you can file your own taxes. You don't need to file as a family. CRA has different standards when it comes to divorce and taxes as compared to legal system, as I mentioned, and will not consider a separation to have occurred if you continue to live together in the same household. For separated people, just briefly, I would like to mention the eligible dependent amount that you can claim to lower your taxes. This credit was introduced for single separated individuals who are not claiming the spouse or common law partner amount. And on the next slide, I will mention more more insights about taxes for divorced and separated people. When you and your spouse divide up your real estate, savings, investment, pension, this is called division of assets. Paying your spouse their half of the assets, it's called an equalization payment and an asset transfer. During a divorce, asset transfer, regarding this asset transfer, there is a strategy which is called rollover provision that will delay any taxation on the transfer. It's very good to talk to a lawyer and an accountant regarding this in order to get a best benefit. And also to talk to a certified divorce financial analyst that will give you the best advice, because they are really specialized in this area. And on the next slide, I will pass it on to Jaina to explain more of the legal aspect.
Thanks very much, Andrea. So I know we've gone a little bit over time, but hopefully you guys can hang in with us for another couple of minutes. So I'm just going to quickly run through some of these separation issues. So taking over onto what Andrea was saying with respect to the division of assets. So like I mentioned earlier, for married spouses, there is an automatic property entitlement for property division. And that's dealing with the equity that has been accrued from your date of marriage until the date of separation. And this includes all assets and debts. And so there are special treatments with respect to the matrimonial home, which I don't really have time to get into, but if you have questions, please don't hesitate to reach out to me or another family law lawyer to talk about it. But in essence, I wanted to sort of let you guys know how things are calculated on a marital breakdown. So we look at each spouse's total assets. We deduct the total liability that they have, and anything that they have brought into the marriage. So, you know, let's say if someone had a condo prior to marriage and that condo was worth $400,000, that is a deduction for them, because what they brought into the marriage they can take out. And so once we add up and deduct these things, that gives that particular spouse's total equity amount. So I have an example here. So if we look at a married couple, so spouse A, on that person's side of the equation and looking at that person's assets, they have $800,000 in equity after it's all said and done. And on the other end, spouse B has $600,000 in equity. From a family law perspective, and in terms of what we are looking at in terms of division and entitlement, spouse A has to pay spouse B half of the difference in their equity. So that's $800,000 minus $600,000, which gives us a total equity difference of $200,000. And that means that spouse A has to pay half of that $200,000, which is $100,000 to spouse B. Now, how that amount is to be paid is something for them to work out. So, you know, whether it's by way of a cash payment, part of it as an RSP rollover or a pension transfer. So there are lots of different options for couples to explore there. Next slide, please. Okay, so other issues that pertain to, you know, not just married spouses, but again, just a couple of things for me to highlight and for people to make sure that they're thinking about as they're engaging in the separation discussion or divorce process. For child-related issues, here are the three sort of major things we look at for child-related issues. So first is custody, and that's in dealing with major decisions making as related to the kids. So, you know, what schools the kids would go to, if there's a medical decision to be made, if there's a dental decision to be made, and if, you know, there's a particular religion for the child or children to be raised in. The next big consideration is access and time sharing. So what is the time sharing schedule going to look like for the kids and with the now separated parents and in separated households. So there would be a regular time sharing component. So, normally that would take place from, let's say, September to June for when the kids are in school. But there should also be consideration given to, holidays, Christmas, the kids' summer break from school, March break, and things like that. The last and not least, the biggest, one of the big components as related to children is the child support issue. So regular amount of child support is legislated. So for separated parents, they pay based on their income in a given year. And that's to cover the kids' daily living expenses. Beyond the daily living expenses, there's also something called extraordinary expenses, and that would be extra expenses on top of the kids' daily living needs. And so that can be, anything that's paid for daycare, if there are additional out-of-pocket medical or dental expenses, and then also, in looking to the future, when the kids are applying to post-secondary education, the parents may have to share in some of those costs as well. And those are usually shared by the parents in accordance to their income. So if they make about the same, it would be a 50-50 split. If someone makes a little bit higher than the other person, then it could be 60-40, however the numbers come out. With spousal support, we've already briefly talked about that, but there are possible spousal support claims. Again, this is very fact and circumstance driven. So it does depend on the particular circumstances of the couple and what roles were taken, if there are any disabilities and things like that. Next slide, please. Okay, so for married spouses, how can you protect yourself? So again, as a proactive step, if you were already in a cohabitating relationship, so prior to marriage, it makes sense to engage in a cohab agreement that can be turned into a marriage contract. Or if you don't have a cohab agreement, then have a marriage contract in place prior to marriage that clarifies, the property ownership terms. It confirms or that there are spousal support entitlements, or it confirms that there are no spousal support entitlements, and also outlines estate rights. So who's entitled to what if someone were to pass away. So if two people are now looking at a separation, the marriage is not working out, a separation agreement is very valuable in terms of closing out on all of your separation issues. And again, those are the issues that I've already talked about. And last but not least, very similar to the common law spouses, very important to update your will. And this is, again, to close out any potential estate entitlements from your ex-spouse. And again, also to ensure that there are adequate support provisions that are made. And next slide. Okay, and one quick point I wanted to mention with respect to obtaining a divorce in Ontario. So in order for someone to start the divorce proceedings in Ontario, at least one of the spouses must have lived in Ontario for the past 12 continuous months. And there is a 1-year waiting period from the date of separation until when a divorce would be granted by the court. This period can be shortened when someone has made a claim of some type of abuse, or if there was an extramarital affair. But then those claims can get pretty tricky, and in terms of shortening the timeline, sometimes it's not worth it. Also, something for people to note, if the child-related issues are not resolved, there is a possibility that the court would not grant a divorce until these child-related issues are resolved. And most often, it's related to child support issues. Next slide. Okay, so there are 4 main ways of couples to resolve the issues, and I'm not going to go into detail in it here, but the first and most amicable way is by negotiation, whether it's between the spouses or maybe through the assistance with their own lawyers, and for anything that they've come to an agreement to be formalized into a separation agreement. There's also the option of mediation. And the mediator facilitates discussion, but they don't make decisions. With arbitration and court, these are more costly options. Arbitration is like, in not so many words, a private court proceeding. It's much quicker than going to court, but the costs are potentially higher because you would have to pay for the arbitrator's time in addition to your own lawyer's time. And then there's always the court route. Next slide. Okay, here are some legal resources. So I don't have time to get into that here, but definitely take a screen capture because they do provide a pretty good wealth of information there. And next slide.
Just some financial tips very quickly. When you are separating as married spouses or divorcing, Jaina already covered mostly all of them, is beneficiary and will changes are necessary, especially if you don't want your money to go to the remaining spouse. But when it comes to children, beneficiary information sometimes doesn't get changed. The remaining spouse still takes care of the children. Definitely sit down with somebody, sees how it works when you have blended families and additional children are being added. When you have insurance policy, you have different products, they all have beneficiaries on them. So making sure beneficiaries are changed everywhere. Investment transfers, making sure that the investment transfer on your will are going to the right places, to the right people. So necessary to make those will and estate planning changes. And keep in mind, everything doesn't transfer over quickly and immediately. They do go through that probate process. So knowing that if you're looking for your money to go over to a family member, it's not going to happen quickly and it's not going to happen easily. And everything in terms of pensions doesn't transfer over. So that happens during the retirement time. So looking and understanding that even though that money is claimed by you and it's going to happen, it won't happen immediately. Jaina's already covered it, Andrea's already covered it, but dividing costs based on your income. So I know a lot of individuals that I've worked with have just, because they don't want to argue, they often take the short end of the stick. So oftentimes it might save you a little bit of peace of mind to sit down and say, okay, I'll incur most of the costs. But that does come at a cost to you financially. So looking at how deep that cuts your pocket is very, very important. Always having somebody there, not just a financial professional, but having a legal professional to guide you through those matters and let you know what you're legally entitled to is so important. And keep in mind, costs will be higher. Rate those in. Costs will be higher for the first year or two because you're basically setting up two homes. So that financial implication will be a little bit higher for 2 years. And keep in mind, it's a living document. It's your finances never change. You're not set in stone. You should be reviewing everything, no matter what situation you're in, every year or every time your life changes. So if you are getting a divorce, if you are getting separated, or if you're getting married, if you're having a child, anything new changes in your life, take another look at that financial plan. Sit down with your planner and see how everything's sitting. And your financial planner is going to contact you when things are changing in the financial market. For example, mortgage rates right now. So keep in mind that it's just a living document in that way. And thank you. So very quickly, I'm just gonna stop sharing screen, but if you wanna get a hold of any one of us, this is Andrea's information. Please take a screenshot. And this is the way you can get a hold of Andrea. And if you need to get a hold of Jana, this is her contact information. You can contact her through, and you can also Google Jana and Andrea as well. And this is my information. You can get a hold of me. I still have my Vancouver number, but I'm going to keep it. It'll be fine. So you can also Google me as well. And we look forward to helping you out in that landscape, wherever you are in your life. And we are finished here, and I will stop sharing your screen. And off to you, Aisha.
Thank you so much, Niru, Andrea, and Jaina. We have a couple of questions, so if you guys don't mind, let's get on to it. Before I start, Alison, do you have any questions for us? Can we unmute her?
She can unmute herself.
Oh, I actually don't have any current questions. I found it quite informative. The reason I was interested was my own personal situation, which my partner is still trying to, I guess, sort out his child custody
Okay.
And yeah, anyways, I was actually also very interested in the cohabitation agreement, which I'll talk with you at some point, Gina. Thank you.
Sounds good, Allison.
Okay. We have a question. I don't know whoever wants to answer this. So somebody asked, do they need to get a joint will as a family, like for husband and wife, or should they have individual wills?
I'll take this question. So with respect to wills, each person has to have their own will. So there's no joint wills per se. But where people make a reference to a joint will, or maybe also mirror will, is that their wills reflect each other. So, spouse A, is leaving everything to spouse B, and then spouse B's will, everything is being left to spouse A and vice versa. And so their instructions are the same, but, it's just sort of in their own individual document.
Okay. So the second question was, can you explain a little bit more about rollover transfer? Or Andrea, I think that one's for you.
So the rollover provision during a divorce, when the asset is transferred, so the parties are going to divide the assets at the time when the separation and divorce is happening, and it's legal actually. And then, for example, an RRSP. An RRSP, if it's cashed, it will be taxed as a lump sum at the time when it's cashed, and that will target a high tax rate. But if the parties decide to leave it and plan it, for later on, after retirement, for example, they can withdraw small amounts in different years, and then the taxation will be, of course, lower, and everybody's in benefit because they will benefit more from it, opposed to versus cashing everything as a lump sum at the time when the separation happened. So that is an example of rollover provision.
Okay, thank you so much. And I think this one was for Nehru. Can you tell us a little bit more about the Canadian Learning Bonds?
So Canada Learning Bond is a grant given by the government. Similar, it gets added to the RESP but some families, they can't afford to put in a registered education savings plan per month. So the government has a certain bond set aside. Lower income families can apply for this, and they can just they can open that account, and it'll open up about $1,500 in total that will go into the account, and that can invest that money and get it growing for them. But many families don't even access it. So it's, whether or not they want the amount or not, it's available to them. So most families are not even taking advantage of it. So trying to educate families and let them know that, it's better than zero money. Even if it's a small amount, it's so helpful, especially when you're a starving student, and it can go miles in that time. So there's so many other things out there that lower income families can do to set themselves apart. And this is exactly one of those pieces.
Okay, like you said, the families are not accessing it because they don't have knowledge about it, right? So having knowledge about it is very important. So thank you so much, everyone. This was wonderful. And this was the second part in the educational series. We are going to be back with two more. One is on September 29th. It is on business ownership, and on October 1st, which is going to be on estate planning. So stay tuned. We are going to be back, and we're really sorry for the because we were Zoom bound. But thank you for staying with us and watch it. And it was very knowledgeable. So thank you to our experts, Neeru Padmanabhan, Andrea Vladescu, and Gina Sang, so much for sharing your knowledge with us. Take care and good night.
All right, great job, everybody.
We're still recording.
Oh, stop.